first guest is a good friend of mine, Sim Tshabalala. Sim and I go a long way. Sim was born in Hlabisa in rural KwaZulu-Natal. He grew up in Soweto, educated at Sacred Heart College in Johannesburg. He holds a Bachelor of Arts degree and a Bachelor of Laws from Rhodes University. He served articles at Bowman Gilfin. He holds a Master of Laws from Notre Dame in the US and was awarded, I need to pronounce this well, summa cum laude, 1993. Is that how you pronounce it?
Summa cum laude.
Oh, I tried, hey? Summa cum laude. He was admitted as an attorney of the High Court of South Africa in 1994. What a year to be admitted as an attorney in South Africa. I'm going to ask him why he decided to leave law later on. Sim was then appointed Chief Executive of the Standard Group in September 2017, after a very interesting period, which we're going to talk about again, having served with three co-chief executives, and I want to know from him how that was. That is as far as it goes in terms of giving you a sense of who Sim is. As was said in the introduction, most of you know Sim, but I thought I should just remind you about how distinguished this man that sits in front of us here. Sim, we're so grateful that you were able to join us. So how we're going to play this, people, is this. Sim is going to talk for about 20, 25 minutes. And then after that, we're going to have a Q&A, me and him. And then after that, we're going to have a Q&A with all of you. This is an important subject, the future of banking in Africa. Your questions, all your questions are welcome. We've got people, we are live, by the way, on our platform. So I should say, welcome to all our guests all over the world. In conversation with Trevor is now boasts 4.4 million viewers all over the world. 46% of our viewers are in Zimbabwe. 54% are all over the world. 12% are in South Africa. Another 13% are in the UK. We've got a huge following amongst diplomats and international organizations that are interested in Southern Africa, in Zimbabwe, and on the continent. So welcome to you all online. Welcome to you in this live space. Sim, the show is over to you. We're looking forward to the insights that you're going to share. Please.
Thank you very much, Trevor. And thank you, Howard, for this great opportunity. And thank you, folks, for being present to be part of this discussion. As Trevor's requested, I'll start with some framing remarks, and then we'll get into the really interesting part of the discussion, I guess, which will be the Q&A. I want to begin by making the obvious point that banking is a derived industry. In that I know very few people that delight at taking a loan, making a payment, buying insurance, but I know that the delight at paying their school fee, child school fees, buying a fridge for their health, buying a home for shelter, buying a truck for the logistics of a business. So it's a derived industry in that sense. And so there's always a fundamental reason for why a human being takes on a financial transaction, buys a product or transacts. And so all the challenges and opportunities that are associated with banking are derived from economic activity, and they're dependent on the economy. I think the second framing point is that financial services businesses don't sit on an ivory tower and are somehow separate from society. They're an inextricable part of the environment and society. And so despite many people's anxieties about banks and bankers, we don't shape society, but society shapes us. And the opportunities and challenges that banks face are created by people's expectations and demands in that sense. And to an equally large extent, what banks do is determined by laws and regulations. In our case, people in Pretoria, who are very powerful. Now, all of these facts set the agenda for what I'll be saying to you this morning. And so let's start then maybe with some thoughts around the economy. The short-term outlook is not good. It's not good. Just as the world was starting to recover from a one-in-a-century pandemic, we're now faced with the consequences of the most devastating war Europe has seen for 75 years. And I don't know about you, but for me, it brings to mind Hamlet's famous line. Well, the line from Hamlet, which is, when sorrows come, they come not in single spies, but in battalions, right? And these big battalions of bad news are causing severe negative shocks to the world economy. For example, the large financial institutions organizing body called the International Institute of Finance just revised their forecasts for the world economy. They're saying now we won't grow at 4.6% in 2022. It looks rather like at 2.3%, with growth in the United States slowing to about 2%, and China's growth decelerating and growing at roughly 4%. And then Europe being the laggards at 1%. The war and the subsequent sanctions are also clearly causing severe pressure. We're seeing it in the oil price, which is likely to remain at above $100 per barrel for as long as the war in the Ukraine persists. And coal prices have also nearly doubled. It's extraordinary. That, of course, is good for South Africa's terms of trade, which is a debate we can come to a bit later. And in many places, we're also experiencing an unpleasant combination of a rapid increase in prices and contractory interest rate hikes. We saw that here just a couple of days ago here in South Africa. The war is also going to put strains on supply chains that actually had not recovered post the pandemic. So think here that we're definitely going to face shortages of fertilizer during the course of this year, with incredible consequences for food production. And we're also facing shortages in semiconductors. Europeans will undoubtedly be paying a lot more for heating, and many face gas shortages. The price of aluminium, copper, gold, titanium, palladium, and nickel will remain elevated, with substantial impacts on industrial sectors like the automotive industry. And this will be particularly severe in Europe. It's also very concerning, I think, that Ukraine and Russia together account for a quarter of global wheat trade. A quarter, I mean, it's extraordinary. And roughly 12% of calories consumed globally. Now, turning specifically to our beloved continent, the picture is complex, but also brighter in parts compared to the global outlook. So our economists at Standard Bank don't currently expect a significant slowdown in African GDP growth. We still expect growth at just over 4%. But of course, a long war or a widening conflict would do more serious damage. So it really is dependent on how long-lasting the conflict in Eurasia is. Commodity prices will be the main channel through which the war affects African economies. So oil exporters, for example, are going to benefit. And remember the point I made, South Africa is going to benefit in terms of trade because of coal, platinum, and other exports that we'll benefit from. That, of course, is also dependent on how quickly people can get stuff to the ports and out of our ports. It's a double-edged sword, I guess. However, the continent is going to face severe food insecurity, particularly in places like Tanzania, which are dependent on imports from that part of the world. Over the longer term, Standard Bank expects that, yeah, the economy on the continent will grow at above 4%, certainly in the period to 2026. And then over the years to come, we think that Africa's population will continue to grow quickly. It'll get healthier. People will be wealthier. They'll be better educated, more urbanized, more digitally connected, and more productive. It follows from that that we also expect trade and investment flows between Africa and the wider world to continue to increase. And then we expect intra-Africa trade also to increase off the back of the Africa Continental Free Trade Area agreement. But the IMF and the World Bank also expect that the pandemic will have caused severe scarring in Africa, far more so than in the developed countries of East Asia, for example. So our continent is likely to take longer to recover and catch up had it not been for the pandemic. It'll probably take the continent 4 or 5 years to recover from the pandemic, whereas it's taken other parts of the world a year to recover. And that's mainly because we're less able than other economies to rely on government spending to buffer us during a period like the pandemic. We just don't have the firepower to do so. And so the pandemic has set the continent back in its journey to catching up to the rest of the world. It's a real tragedy. I think we'll still grow, but we'll be relatively poorer for longer, tragically, as a consequence of the pandemic. So that all brings me to the first set of implications for our industry. We're confident at Standard Bank that in the longer term, the trends are going to be positive for us. So for example, on the retail side of the business, we think people will want a wider range of financial services as financial deepening happens. People get healthier and wealthier. They don't just want to pay, they just don't want to save, but they now want to invest. They want to protect their assets. They want to use the wealth created to pass on to future generations. And therefore, the set of products they require is wider. And that is very exciting for us, given our closer tie-up with Liberty. We've just bought 100% of Liberty, which provides us with great opportunities. On the wholesale side of the business, rapid growth will see increased demand for lending, equity, payment, transactional, and advisory services. As the continent spends money on infrastructure, roads, ports, dams, electricity, they're going to require increased intermediation and advisory services from financial institutions. All, however, is not rosy in this garden. As I've just said, Africa remains the poorest region in the world, and that's the case both relatively and absolutely. In fact, over the next few decades, thanks to the rapid growth enjoyed by Asia, extreme poverty is going to remain the exclusive preserver of our beloved continent, unfortunately. It's horrible to contemplate, but it's true. So we've got a lot of catching up to do. In that context, we as bankers have to be quite realistic about what's possible and what we can sell. My colleague Funeka Monjane very helpfully insists that we should call the lower end of financial markets, where the majority of the people are that we need to serve. She calls that the main market. And I think it's a lovely way to describe it. It's the main market. Excuse me. But if you serve that market well, you achieve a great deal. I think the second implication for banks, including my employer, is that banks must continue to look for opportunities to accelerate inclusion and contribute to sustainability. By inclusion, I mean both inclusion for poorer people into the formal economy, but also the inclusion of the African continent into global value chains and supply chains and economic activity. Doing this is, of course, expected of a good corporate citizen, and I'll say a little bit more about that in a few minutes. But just for the moment, though, I'd like to emphasize the immediate commercial and prudential case for focusing on inclusion. As many of you will remember from your undergraduate economics courses, growth is faster at the beginning. So startups grow very quickly. Old institutions like Standard Bank, which has been in existence since October 1863. I might just add under the same name, the Standard Bank of British South Africa Limited. The only difference now is that it doesn't have British in its name. An old company, so it'll grow, but it's not going to grow exponentially. It'll grow at a steady pace. That's the same and is true for middle class and prosperous cities. Well, they'll continue to do well, but exponential growth happens with poorer families moving into the middle class or large communities moving into greater prosperity. Think of China, or think of Kenya and East Africa, and how in a generation people have moved into prosperity. And bankers are looking for opportunities to grow in that context, and the winners will be those that identify those opportunities better than others. The prudential case for inclusion is just as strong as the commercial one, I think. I don't think anybody in Johannesburg needs reminding that very high levels of economic exclusion create political and social instability. There are communities that you and I know that are like a tinderbox with people running around with matches that are lit. The conflagration is bound to happen for as long as there's these kinds of levels of exclusion. These, of course, are very bad for confidence, for investment, and for growth. And it follows that financial sectors have a very clear interest in supporting more economic inclusion. It just makes, another way of putting it is that for as long as risk is high, it increases the cost of capital. Cost of capital is an input into the determination of the cost that we pay for getting either loans or for equity, and therefore country risk is important to us. We have to make a contribution to reducing it so that we improve the cost of equity. I mean, it's in our interests to do so. Turning to sustainability, here I'm referring both to social and environmental sustainability. And for us at Standard Bank, the two concepts are inextricably intertwined. On the environmental side of things, there's no question that if we want to avoid an accelerating series of environmental disasters and catastrophes, Africa, and of course the whole world, needs to move as quickly as possible towards using only sustainable energy. It just makes so much sense. If you have any doubt, contemplate the terrible human tragedy that we've just witnessed in KZN. And it makes an eloquent case for environmental sustainability, more so than any rhetoric one could muster. But having said that, Trevor, and as we often argue, a transition away from carbon-intensive economic activity won't happen unless it is politically and socially just, hence the notion of a just transition. So that means that transition must respect Africa's right to development. It must adequately protect vulnerable people, and it must help to make life a better place for everyone. That imperative makes it clear that there are incredible opportunities for large banks if you look for them. So over the next several decades, there will be a lot of money to be made from financing new, more sustainable infrastructure and energy. It's an economic opportunity, so one doesn't need a social or a political argument for it. It just makes commercial sense. And to use us as an example at Standard Bank, 85% of our funding of energy projects is already going to renewables. And our sustainable finance book in general is expanding very, very quickly. Moving from economic trends, one can then say that the patterns of market demand and social expectations are also important to think about. And then think about other industries that have transformed in the context of digitization and what has happened, because that's another dimension of what we face. There are many examples one can think of, but entertainment is an interesting comparison. So like movies, TV, and music, banking has gone completely online. I've done this exercise in the past, and I'll do it again. I defy anybody in this room to tell me that they've been to a branch, I won't say of Standard Bank, just any branch of a financial institution more than 10 times in the past year. I defy anybody to put up their hand.
Let's see any hands. Have you been at your bank?
Be truthful. You've been injected with truth serum. Okay, one person. My point, though, is that much activity has moved to digital channels. 99% of activity now happens on electronic channels. And in our operations outside South Africa, it's roughly 95%. Most people use the app, and this is a free advertorial. Thank you. Try the Standard Bank app. It's fantastic.
You'll get the invoice.
Thank you. The point is that people, for convenience, demand of financial institutions the same levels of ease of transacting as they expect from Uber, Netflix, Google, and so forth. And these implications for banking are profound. One way in which they are profound is that you'll remember not too long ago, people were saying the telcos, the big techs, and the fintechs are going to be eating our lunch. They're going to decimate financial institutions. They're going to eat our lunch. Now, the conversation with the likes of Ralph Peter is, let's have a discussion about who's going to pay for the lunch. It's about people are learning pretty quickly that the entry into financial services requires large capabilities. In our case, we employ armies of lawyers, bless their souls, lawyers, accountants, engineers, risk managers, compliance officers. We've got massive systems. I was in a meeting yesterday when we were talking about the need for us to make additional investments. Massive systems on fraud, fraud detection, cybercrime, the amount of money we spend, and the number of attacks that we suffer every day, and the need then to protect ourselves is mind-bending. The need for us to do know your customer. So a lot of the fintechs are suddenly discovering that if you want to play in this game, you've got to be able to do anti-terror, protect your organization, and make sure that you don't get involved in terrorism financing. You need to make sure that you don't facilitating bribery. You need to make sure that when your systems fall over, you're able to deal with your customers, as we learned at Standard Bank last week. An extraordinary period of 6 hours during which our systems were down. And the fury of our customers is beyond belief. And so if you're playing in the space, you've got to have the capacity to manage all of that. And therefore, conversations with these players are now around partnership and so forth. What does an incumbent need to compete? I'd venture to say, at the very least, you've got to have a strong brand, and you have to be able to successfully defend it. Secondly, you have to have sufficient digital skills and resources. Scale matters in financial services. Hence my suggestion to you that even in banking and financial services, fortune favors the big battalions. You've got to have the financial resources and the capability to compete. And then lastly, do you have the digital platforms to be able to compete?